exchange trade funds, also known as ETFs. They are one of the best ways to invest your money in the market in 2023. So today, let me share with you what are the absolute best ETFs that you can buy right now if you're looking for great capital appreciation over the next 10, 20, and 50 years. Plus, at the end of the video, I'll share with you how I would personally build my portfolio if I had to put only these 5 ETFs in it. So without losing too much time, let's get to it right now. For the first ETF on my list, I've picked the one that has the biggest potential of return on the long term, but that also has the biggest amount of risk on the short term. And it is why I've picked the Vanguard Growth ETF with the ticker VUG. This fund tracks an index composed of large US companies that tends to grow faster compared to the broad market. It is why among the 241 holdings of this ETF, you can find companies such as Apple, Microsoft, Amazon, and Tesla. And with no surprise, you can find the technology sector as the largest sector in this fund with close to 50% of it. After, you can find other interesting sectors such as the consumer discretionary, the industrials, and the healthcare. Over the last 10 years, if you would have invested $10,000 in that fund, this would now be worth close to $40,000 or an average annual return of about 14% per year. However, obviously with such high returns over the last 10 years, you can understand that this also comes with a lot more risk compared to the same ETFs of this category. But with some super low management fees of about 0.04% per year, or if you prefer $4 per $10,000 invest in that fund, and some great dividend income distribution that is made on a quarterly basis to their different shareholders, it is definitely an ETF that is worth keeping on your watch list, especially if you have a long-term horizon. But now, if you're telling me, hey, but Louis, I would like to have an option that is giving me more income distribution and that is slightly less volatile on the short term. Well, in that case, another great option for you could be the Schwab US Dividend Equity ETF with the ticker SCHD. Over the last couple of years, this ETF became a favorite of dividend investors because it is tracking the Dow Jones US 100 Dividend Index, which is an index composed of high-yielding dividend companies found in the US market. Indeed, among the biggest holdings of this ETF, you can find great companies such as PepsiCo, Coca-Cola, Verizon, AbbVie, and Home Depot. Plus, within the sectoral distribution, you can find a better diversification compared to the first ETF, where you can find that the industrials, the healthcare, the financials, the consumer staples, and the technology are some of their biggest sectors in this ETF. And compared to VOO, SCHD is investing in many different kinds of companies in terms of market capitalization, but usually to be able to offer great sustainable dividends on the long term, those companies must be quite big, and it is why we can find that over 70% of the total companies within this fund have a market cap of over $70 billion. On your side, by investing in that ETF, you can expect to pay some annual management fees of about 0.06% or $6 per $10,000 invest. And over the last 10 years, this initial $10,000 investment would now be worth close to $34,000, or if you prefer, a great annual return of about 12% per year. And with an average risk versus reward quotation compared to its peers of its category, this ETF is also giving some great quarterly distribution to their shareholders. So this is a perfect ETF for investors looking to receive a lot of dividend income from those companies, because as you must know, when an investor is investing straightly into a company, it means that the company will directly pay the dividend to this shareholder. But since the companies are not paying the dividends all at the same date, it means that the ETFs will simply hold the dividends that they will receive, and when it's gonna be the time, they will distribute all the dividends that they will harvest to the different shareholders of these ETFs. But now, if you follow correctly what I've said in this video, you can understand that I've only talked about ETFs that are investing strictly into the US market. And so for my third pick, I decided to talk about an international ETF, which is the iShares MSCI EAFE ETF with the ticker IEFA. So the role of this ETF is to track large, mid, and small market capitalization companies that are found into developed markets excluding the US and Canada. It is why among the 3,000 holdings of these funds, you can find great companies such as Nestlé, Roche, ASML, and LVMH. And in terms of the geographical diversification, you can find that the three biggest countries of this fund are Japan, the United Kingdom, and France. And the financial sector comes at the first place, followed by the industrials, the healthcare, and the consumer discretionary. On your part, by investing in that fund, you can expect to pay some annual management fees of about 0.07% or $7 per $10,000 invest. And over the last 10 years, this $10,000 would have grown to over $18,000, which represent an average annual return of close to 5.50%. Nothing really crazy, but over the last 3 years that have been pretty volatile on the market and where the market has notably lost a lot of value, well, this ETF has still been able on average to gain about 13% of gain. All of this while giving you access to different markets that are not necessarily known to the public in general. And despite giving you some great international exposure, this ETF has slightly more risk compared to the average of its category. And on their part, they are giving some semi-annually distributions to their holders. Now, for my fourth pick on my list, I've decided to went in another market that is not necessarily well known by many investors, but I've picked an ETF that could see some massive potential of upside over the next couple of years, especially with the global economic markets that might be switching, notably with some super important economic partnerships such as the BRICS. And so I've picked the Vanguard Emerging Markets ETF with the ticker VWO. As you can understand, this fund is investing in companies that are found within emerging markets such as China, Taiwan, Brazil, and South Africa. It is why among the biggest holdings of this ETF, you can find companies such as Tencent, Alibaba, Val, and Taiwan Semiconductor. So this ETF has a lot of potential of growth in the future, but it also has a lot of risk because of the companies that are found within this fund. It is why over the last 10 years, this fund has only gained about 2% per year. This represents a transformation of your initial $10,000 investment to about $12,000 10 years later. And on your part, by investing in that particular fund, you can expect to pay some annual management fees of about 0.08% or $8 per $10,000 invest. Plus, by having less risk compared to the average of its category, this fund is also giving great quality distributions to their different shareholders. As you can understand, by investing in that fund, you are more investing into the potential future performance compared to the past and the present performance. And finally, for the cherry on top, I've decided to pick the best ETF in the world in my opinion, which is the Vanguard S&P 500 Index ETF with the ticker VOO. This ETF seeks to track the performance of the famous S&P 500 Index, which is composed of the 500 largest American companies. So obviously you'll find companies such as Apple, Microsoft, Amazon, and Tesla among its biggest holdings. Can you really go wrong with those companies? And as you can understand, the largest sector of this fund is the tech sector, which represents over 25% of the total assets. And after you have the healthcare, the financials, and the consumer discretionary sectors. 10 years ago, by investing $10,000 in that fund, this would now be worth over $35,000, which represents an average annual return of about 12% per year. All of this while paying some mere fees of only about 0.03% per year or $3 per $10,000 invest. Plus on their side, they have an average risk versus reward quotation compared to the average of its category, and they are also giving some great quality distributions. So as you can understand, it is pretty much a great ETF to invest in if you want to invest in the overall market. So there you have it. Those are the best ETFs that you can find on the market in 2023 if you're looking for great capital appreciation over time and some great diversification in your portfolio. Personally, if I had to create a portfolio with those 5 funds, I would allocate about 30% of my total assets to VOO and SCHD. After, I would allocate about 15% to both VUG and IEFA, and the 10% left would straightly go to VWO. But now you might be wondering, hey, but Louis, what are the best stocks that I can buy right now? Well, to find the answer to that question, check out the video that's gonna be right over here, and I will see you soon. Peace!